to pick winning stocks in Kenya, in the Kenyan stock market. Well, hello there, and welcome to today's video, whereby we are going through the Kenyan stock market. And I have a very important guest right here, but I won't introduce him. I'll let him introduce himself.
Hi everyone, my name is Davis Kadinji. I'm an analyst with Sterling Capital. Yeah, and I'm glad to be here today.
So, Davis, what is fundamental investing?
So fundamental investing is when you look at the underlying fundamentals or the key drivers of a company. So it can be contrasted with something like technical analysis or chart-based investing, whereby you don't really care about the specific company in and of itself, what it does, its growth prospects and the like. But your key concern is based on the charts that I'm looking at, based on the price action, volume, etc., how can I make money off of it? So you see there's a contrast there, because in one, you're just looking at charts, you're just looking at momentum, you're looking at interest, etc. In the other, you actually care about what does this business do, is it able to grow, what are the key risks that the business faces, etc. Yeah, so you're looking at the underlying key drivers or the fundamentals of the business. That's basically what fundamental investing is. Yeah.
Okay. So for fundamental investing, we look at the key drivers.
Yeah.
For trading, it's just the chart.
Yeah.
So how do Kenyans actually make money investing?
Invest. So there are few ways you can make money investing. One is through capital gains. So you're basically looking for stocks which have the best or the greatest potential to move up. So for example, from 10 to 20, that's a capital gain. If you manage to invest in a stock at 10 and then it rallies all the way to 20, you've made those 10 shillings, which is like doubling your money. Another way investors can make money is through dividends. So dividend is whenever you buy a company or shares, you have a claim to the or rather the earnings of that company. So that means that if that company pays out earnings each year in the form of dividends, you have a claim to that. So they say, okay, let's say you bought a stock at 10 shillings and then they pay a dividend of 1, that's a dividend yield of 10%. So you'll make that 1 shilling. Basically. So that's another way investors can make money. And so those are the two primary ways investors make money off of this. There could be other things, unique things that happen, like let's say a big investor comes and then they buy out smaller investors, as we've had recently, like let's say Bamburi. But those are not exactly, like people wouldn't buy stocks based on, okay, maybe someone else will eventually come and buy this company, Yeah. So, because it's a bit more speculative, but yeah, there could be possibly investors like that, but it's not as common as for capital gains as well as for dividends. And also, you get a capital gain if someone came and bought you off. Yeah.
Yes,
Yeah.
right. So dividends and capital gains.
Yeah.
And sometimes getting bought out.
Yeah.
Very nice. So if I have 5,000, which stocks would you recommend I get started with as an investor in the Kenyan stock market?
Okay. So the first thing to note is I normally refrain from telling people just buy this and you'll be fine, because at the end of the day, I haven't assessed your risk tolerance. So risk tolerance means for one person, they can buy a stock knowing that they'll sleep at night if it goes up and down. So for example, they've bought at 10 bob and then it drops to 5 bob after a while. One person won't panic. Another person will panic if it drops from 10 to 9.5. So there's different kinds of investors. So it's good to first of all know what is your risk tolerance, what is your investment period, just asking yourself a number of these questions. If anyone ever tells you just buy this and you make money, that's a con man. Yeah. But with that in mind, there are some attractive plays, especially now as we enter earnings season for banks, given this is March. So in March, a lot of banks will give their earnings, they'll likely pay out dividends and the like. And so the banking sector does seem to be quite resilient. So focusing on the bigger banks would be attractive and relatively affordable. And a good place to start for the retail investor. Yeah, that's what I'd say. Yeah.
Banking sector for anyone who is looking at that. Also, look at your risk appetite.
Yeah.
And also your long term, whether you're investing long term or short term.
Yeah.
Very nice. So So what are the three factors that I should look at before I buy a stock? Three factors.
Three factors you should look at. So, first of all, you should look at the nature of the earnings or the quality of earnings. Like, you don't want a stock whose earnings are very volatile and based on seasonal trends. You want something that's a bit more consistent. So, consistency going up, or ideally, you don't want a stock whose earnings are consistently going down.
Yeah.
But yeah, so that's one. The quality of earnings may be less volatile. Also, you want to see the long-term prospects of the business. So, is this business subject to material risk factors? Like, can it be disrupted completely by, nowadays, I guess the trend is AI. So, can it be completely disrupted by things like that, or habit changes, consumer changes and shifts and the like? So, for example, think of, before when you're in high school, you'd get letters, so poster. It was more popular back in the day, but nowadays you just send texts. So you can tell that, okay, this business is just dying. Like, the future prospects are not as good. Yeah. So the earnings quality, you can also look at things like management, just the understanding of the business, the plans that they have for the business. You should also look at, okay, so I'm saying many things.
Okay.
But the last one is, of course, risk factors. So what things would materially affect this business? So, for example, some businesses in Kenya, you'll notice, are really affected every election cycle, because elections come and then it's like business just dies off. So if you know that, you'd know it might be prudent to avoid this business during an election cycle, because people may sell off the share. Yet even when they sell off, that may be the best time to buy, because guys are panicking, it's going down, down, down. Then as it goes down, maybe you're buying a little, knowing that this just happens during the election cycle, and I'll just buy now and then it will pick up again later on. But it's worth knowing that this is how it will impact the earnings and the like. Yeah. So I'd say just the quality of earnings, future prospects, management, risks factors. Yeah, I know I've said many things, but yeah.
Thank you. We appreciate it. The more the better. So, what are financial statements?
So financial statements are basically what they are, the statements that the company gives you. So there's like the financial statement position or the balance sheet, whereby you'll get a snapshot in time of assets, liabilities, and equity. You get a statement of shareholders' equity, just showing changes in shareholders' equity, statement of cash flows, and then the profit and loss statement. So this enables you to see how is this company performing, and that's what we as analysts use to inform whether we're investing in this company or not.
Okay. And in the financial statements, which numbers should I, as an investor, focus on?
Okay. So now that one, it really does depend on the nature of the business, quite a number of things, but I can give examples. So let's say in the banking sector, you'd want to focus more, you start with the asset book. So you want to focus on the loan book. Is it growing? You want to focus on things like non-performing loans. Are they going up? Are they going down? Because you wouldn't want, yes, this business is growing, it's giving out a lot of loans, but the quality of the loans just keeps on going down, because that will impact the earnings, it will impact revenue. So that's at least for banking. With regard to, for example, with regard to things like the manufacturing sector, you don't focus on things like working capital, so current assets and current liabilities, seeing whether they're able to pay off their short-term liabilities with short-term assets and the like. Yeah, and then, okay, now if we focus generally, let's say on the profit and loss statement, you'd want to focus on revenue. Is revenue growing? What is driving that revenue, etc.? Is revenue growing faster than costs? Because yes, revenue can be growing, but if costs are growing faster, then that's not exactly a sustainable business, because its margins are thinning out. You want to look at operational costs, because that one they can manage quite a bit on a company basis. Then, so net profits, yes, it can be an attractive thing, but you want to see just the level of sustainability of that. So you want to now turn to something like the statement of cash flows, because cash flows is actual cash. On the P&L, there are some things that a company can record, so like revenues, you record even though you may not have received the money, for example. Yeah. So you want to also focus on things like cash flows and be like, okay, yes, the business has stated that revenues are coming in like this, yet this could just be revenues that they expect in the future, not revenues that are there now. Yeah. So you want to focus largely on those three statements: the P&L, the balance sheet, as well as the statement of cash flows. Yeah, and then you build up from there. It's a process, it's learning, it can be boring, but I find it interesting. Yeah, I guess 'cause maybe I'm passionate, but yeah, it can be interesting as well. Yeah.
Nice, nice. So the three statements, financial statements.
Yeah, focus on those, yeah.
Okay. So how important is management and leadership when choosing a stock?
Yeah, oh man, that's very important. So I can give you an example. So there are two companies that, let's say 10 years ago, both of them, one of them had a very good strategy that was laid out, very good growth prospects, etc. And had you invested in that company at that point in time, you know, 10 years later, you'd have been looking at, let's say, you'd have doubled your money having invested in that particular stock, just because of management has a strategy, they're executing on their strategy well, they're able to articulate their strategy well, etc. And then now it's contrasted with company B, who the management, first of all, the turnover is extremely high. So turnover means this is changing management every other quarter or something, and that's a red flag, because you need to ask, okay, why are people leaving so often and the like. They didn't have a clear strategy, or rather the strategy that they had was not reflective of the economic realities on the ground. So unfortunately, that share price ended up declining almost 80%. So you'd have invested 100K, you come out to 20K. Yeah, all because the red flags are there. So management doesn't seem all too greatly concerned about the nature of the business, how the business, the growth prospects of the business, the risk factors, it being, them taking into account the situation on the ground, the realities on the ground, and also how management is changing and turning so fast.
Yeah.
All those are. So you're just seeing those two. Management plays a huge factor. It is a huge factor. And even being able to sell that vision to investors. Because yes, a company can be attractive, but are people buying into that specific
Company.
based on just how management seems like, oh wow, they're going to execute well. Execution risk is actually among the biggest risks. Like, yes, you can sell us the whole story, but now, you don't know how to execute, and
The execution is the issue.
yeah.
Okay, so what are some strong, stable stocks in the Kenyan stock market for beginners?
Okay, so with that one, it's largely blue chip stocks. So let's say you have Safaricom, you'd have big banks like KCB, Equity, Cobank. Those are the more stable companies, and thankfully they're also listed, not listed, but they're being tracked by global investors as well. So they have inflows coming in. They're attractive and and they're reflective of the entire economy. So those are the primary stocks that investors can look at coming in as they learn more about the stock market, as they slowly progress, and those are the most stable stocks. Yeah.
So blue chip stock.
Yeah.
For anyone who doesn't know what a blue chip stock is, could you break it down for them? Because we have so many beginners on this channel.
Okay. So blue chips are basically your large stable companies, if I just summarize it in a simple way.
Large stable companies. Okay.
Yeah.
That's good enough. So how can someone know if a stock is a good long-term investment?
Yeah. So again, that really does depend at the individual level why you're choosing to invest in this specific stock or not, and what you're trying to achieve. So for some people, they can look at a stock. Okay, you can contrast. Let's say investing in general. You're supposed to look at investments in comparison to other investments. So let's say you want to look at stocks in comparison to bonds. Okay. So with stocks, or let's say dividends, if someone is looking for consistent earnings that are growing, like let's say they've received a bulk amount of, I don't know, $1 million, for example, and they want something that can give them earnings each and every year, they can compare stocks or bonds. if they want the potential for greater earnings, with a bond, you have a consistent payment. Every 6 months, you're receiving this amount.
You're sure of it.
Yeah. Whereas with a stock, if you're willing to take on that risk, because stocks are perceived to be a higher risk, dividend payments can actually keep going up. Okay, so for some counters like let's say Standard Chartered, people buy it because the dividend just keeps on going up and it's a strong and stable company. So you'd notice that, okay, maybe this year they paid a dividend of 24, next year they pay a dividend of 29, etc. So that's contrasted with, like, your yield keeps on going up. Maybe your yield last year was 12%, now it's 15%, whereas with a bond, it's more like it's 12% throughout.
Yeah.
Yeah, so that's one thing worth considering. And also, if you want greater opportunity for capital to grow. So with bonds, for example, I'll really try to simplify this, but a bond, when you buy it, it often is at par value. Par value is just 100. So and that bond can trade up or down, meaning that it can trade at 105 or it can trade at 95 based on, let's say, things like interest rate movements and the like. It doesn't mean that your coupons, the payments you're getting every 6 months are changing. It just means that if you are to sell the bond, you can sell it for different values. But the capital appreciation potential for a bond is quite limited. So for example, it's unlikely that you'll see a bond trading at 150, for example. They'll likely trade at a specific range. Whereas with stocks, literally you can buy at, let's say, 10, it moves to 20, it moves to 30, it moves, etc. And vice versa, it can go from 10 to 5 to 1, if you haven't chosen well. Yeah.
Nice. So, what role do economic factors like inflation play in the stock market?
Yeah. So, okay. Let me give an example of interest rates because it's easier to explain that with banks, for example. Let me use inflation first. Let's say inflation is high in a country. Then the question can become from clients, okay, should I buy this specific product? Like, let's say, should I buy credit or should I buy food? Because your income is staying the same and yet inflation is high and it's eating away. And so the question becomes, okay, what are those key items that are needs and not necessarily wants? So with some things you'd be like, okay, it makes sense for me to forego particular products over others. So let's say your luxury goods. Knowing that in mind, you'd be like, okay, inflation is going to be high next year based on forecast, etc. So that means that the demand for certain goods and services will come down. And so in light of that, the earnings of this company are going to be impacted because of that. So that's how you start thinking around that. Or you think of things like interest rates. Interest rates are set to go up, for example, next year based on this and this factor. And that company has a lot of debt. That means that, debt is normally floating. Like, it's not a fixed rate, it normally shifts. Yeah, so you may have been paying a loan at 10%, then next year it's 20%. That means that it's impacting your finance costs, so earnings go down. Yeah, so that's how different macroeconomic factors affect companies, and this is worth being cognizant of them. So some things that are positive, like inflation coming down, is generally positive. Interest rates coming down is generally positive because people can borrow at lower rates, and also it makes stocks more attractive. Because again, remember, you're looking at different asset classes. So if interest rates are coming down, that means that the returns on bonds are coming down. So instead of investing in bonds, you'd be like, okay, let me invest in stocks. So more money starts going to stocks and stock valuations start going up, for example. Yeah, so that's how the things
Economic
you can think.
factors affect the performance of stocks.
Yeah.
Okay. So as a new investor, you should be up to date with what's happening.
Yeah, it helps to be so. Yeah.
Nice. So, what's the biggest mistake beginners make when investing in stocks?
I think not even beginners, this is everyone in general, is looking at a stock and saying, okay, this stock is trading at 1. That means that it can easily go from 1 to 2, rather than buying this stock that's trading at 100, because it's moving from 100 to 200 is harder. That's not how things work. If that company is at 1, you need to ask yourself, why is it trading at 1? Have people been selling it off so much because of how it's been performing badly that now the share price is there? And this stock that's at 100, why is it? So the biggest mistake I often see people doing is to reason that, okay, this stock is trading at 1, and so it can move from 1 to 2. vis-a-vis this other stock that's trading at 100 and can move. It's harder for it to move from 100 to 200. Yet, people don't ask themselves, okay, why is it trading at 1? Is it that the company is doing badly, has been performing badly, hence its stocks have been sold off till now it's trading at 1? And this stock that's trading at 100, why is it trading at 100? Is it that the company is strong, for example? Yeah. So that's the worst thing. So you shouldn't look at the share price and think, okay, this one is expensive, this one is cheap, so I should just buy the cheap one, it will make me more money. It can lose you a lot of money.
Yeah.
And the one that is stronger can end up, or at a higher price, in an absolute sense, can actually end up making you more. Yeah. So that's among the biggest mistakes. So not doing research, instead just saying, this thing is like this, it's like this, let me just buy. And then now suffering the consequences of that. Yeah.
Okay, nice. So you said something about just because it's trading at 1 shilling doesn't mean it's cheap. It might be
Yeah.
expensive in the long term.
Yeah, cheap is expensive. Yeah.
Expensive. So, is it true that only the rich people can invest in stocks?
No. Anyone can invest in stocks. Right now, it's quite easy. So all you need is basically 100. So let's say Safaricom is trading at 18. So if you need the least amount you can buy is 100. Though I know at some point that may change such that now you can almost buy anything. But as at now, it's 100. So that means if you take 18 times 100 plus some cost, it will maybe cost you 1900 to buy a specific stock. So you see, it's not that expensive. I believe you just plan yourself. You can say, okay, this month I'll buy this amount, next month this amount. Then you slowly build up like that. It's a process, it's a journey. Yeah.
Journey.
Yeah.
So with less than 2K, you can get started.
Yeah.
Nice. So, should Kenyans focus on the Kenyan stock market alone, or they should explore other options?
So of course it is good to explore, but the best thing is to start small and then expand from there. Because you have, I don't know, hundreds of thousands or even millions of companies all over the world. So it's hard to just, you'll be so confused wondering, what do I begin with, where do I go, etc.
Yeah.
So things like ETFs, exchange traded funds, help because they help you buy a basket of companies all at once. We don't have that in Kenya, but if you do have exposure to global stocks, you can buy global ETFs. So it makes it easier.
Yeah.
Yeah, but if you're investing in the local market, since we don't have that many companies, they're slightly above 60, you can begin with a specific company, understand it, and then now use that as a benchmark or a base to continue looking at other companies and growing in that regard. Yeah.
So start small,
Yeah.
then you can.
Yes.
Okay, so how do I, as a new investor, avoid stock scams, pump and dump,
Pump
all
and-
that? Yeah.
Interesting. Well, so it's best not to invest based off of hype. So like, some group has said they're going to run to this specific stock, pump it up. Avoid things like that. Look at the underlying fundamentals of the company, read research reports, ask questions to those research companies doing those reports, or even management if you can during AGMs, to understand the underlying business. See, the free float of a company. That just means, the outstanding shares, who are the primary investors, etc. And don't just buy a stock because it's been moving up and up, because you can find that may be a pump and dump, especially if it's moving up and up with very small volumes, like 100 shares or 1,000 shares each and every day. That could be a bit suspect. So it's worth bearing in mind. So look for companies that have heavy volumes that you can trade, that are trading, and just that are stable. Yeah.
So look at the volumes.
Yeah.
So, what are the best ways for a beginner to start doing their research on stocks?
Yeah, so, well, it's really easy to start researching stocks. You can start with the specific company reports. So you can go to either the company website, just search the specific company. If it's, I don't know, Equity Bank or Equity Group Kenya, then search Investor Relations or BAT Investor Relations. So then now you go see the financials. Then you can start reading and learning and understanding the company. Like, okay, what does this company do? Which business lines is it in? So you just start generally reading, and then now you go to the specific financial statements, and you'll notice that with the financial statements, they have notes to those statements. So you look at the statement, then you look at the notes, so that you understand, okay, revenue, it says I go to note number 4. So you scroll down, you go to the notes to the financial statements and understand, okay, this is what their revenue is, this is why it's growing, this is etc. Slowly by slowly, you just pick up in that way, just by reading about the company itself. You can also look at online sources. Yeah, just that simple.
They're nice. So look at the reports of the company.
Yeah,
And then plan to read the reports.
yeah.
Okay. And is it easy?
So I guess if you're interested, I mean, okay, if you're looking to make money, I guess you want to learn and understand the nature of the business. You want to see just, okay, you're treating it as if this is one of the ways I could potentially unlock returns, and so I should put in the work. You know, it's like exercise. I mean, when you start,
yeah. Okay. So where can I access financial reports and stock data easily?
Yeah. Well, okay. For the financial reports themselves, a good website I've seen is African Financials. That has this every company in Africa or the specific company that you're looking for. Just look at that specific company and go to the investor relations page. And for data, I guess one place you can look is My Stocks. I don't know if you've heard of it. Yeah. So there it's easy to just find at least a few charts, etc. Yeah. So those are the most or the simplest places. Yeah.
Thank you for sharing. Not many people are open with that. So if I was to pick one stock, what should I do next? I pick a stock today, then what should I do next?
So the immediate thing is just to understand the company, understand what it does. You know, if you can't even say what it does, that's a problem. You probably shouldn't be investing in it. So yeah, you go look at their financials. You go try read and understand the nature of the business. Try see if there are videos online that explain this specific business, because there are numerous videos you can find online on different companies that maybe are done by the NSE itself, the Trading Bell, Business Daily. You know, just different things that you can look into. Subsequent to that, now you start reading the financials and trying to see, okay, does this business, what are the possible growth prospects? And if possible, you know, you can put it all on an Excel sheet, like, okay, or write notes. So this is what this business does, this is what they're saying. How is what they're saying actually true, in the sense that is it achievable? Even you as a layman, when you look at so a company that says, okay, we have 1 billion today, but we'll make it to 100 billion in 3 years. You ask how? How is that possible? It may be unrealistic expectations, or is it tangible expectations? They're telling you, okay, we're expecting, let's say, consumer demand to pick up because inflation is coming down, for example. Yeah. So you just slowly by slowly build up. Like, there's no straightforward path toward this. I can give general principles, but ultimately it's up to the investor. Just slowly by slowly trying to understand, to learn, to grow, and eventually to make the decision to invest or not. Yeah.
So I have to do the hard work.
Yeah, you have to put in the hard work,
So
or pay someone to do the hard work.
pay someone.
Yeah, or pay someone like an analyst, or research houses. You can read a lot of research reports from different companies. If you have a stockbroker, they likely send you research reports. So those are good places to also start.
No?
Yeah.
So your broker.
Yeah.
Most probably.
Yeah.
Those emails that they send, look at them.
Yeah.
Okay. So what is the best mindset for a long-term investor in the Kenyan stock market?
Well, literally says that. Just think long term. So don't imagine that you'll get returns tomorrow. Though it could happen sometimes. Remember, there's something I think Warren Buffett said. It's like you should view a stock from the basis of, okay, if I were to buy this stock today and the stock market closes for 10 years, you should be comfortable with investing in it. But then again, that's one of the principles, not necessarily a rule. So just invest with the mindset of, I'm comfortable with this business, I like where it's going, such that even if there's volatility, so ups and downs, you're comfortable with that volatility because you know, okay, the business still long-term makes sense. Yeah.
Okay. I'm not sure whether we answered this, but how can I know if a stock is overvalued?
So eventually, as you're looking to the company's fundamentals. Let's say you'll now delve into something called financial modeling. So you'll build up a financial model based off of the company's financials and say, okay, and then eventually through that process, it's a long process, but eventually through that process, you come up with a valuation for that company. If the company, or alternatively, an easier way is, let's say, different brokers giving their fundamental estimates of that company and saying, like, let's say this company is valued at 20, the share price is at 15, and so it's worth buying because you can make that 5 shillings at least. So that is one example. Another scenario could be where the stock is trading at 50 and the intrinsic value or the fundamental value is 30, at least from your own analysis or that of other brokers, etc. Then you'll know, hey, this company is too, the share price is too rich, probably shouldn't be buying at these levels. So you want to look at, let's say, the fundamental value vis-a-vis where the share price is. You can look at other things like share multiples. Okay, is this company, it's trading at a price to earnings ratio. So that means that, let's say it has an earnings per share of, that's its total earnings, let's say of 100 million divided by the shares outstanding, which can be 10 million. So you have an earnings per share of 10. So if it's trading at that earning, it has an EPS of 10, and the price is, let's say, 100, that means it's trading at 10 times earnings. And then you look at its peers and see, okay, its peers are trading at, let's say, 5 times earnings. Why is this one trading at 10 times earnings and the others at 5 times earnings? Is it overvalued based off of that? Or alternatively, maybe it's trading below its peers. At 10 times earnings, its peers are trading at 20 times earnings. Figure out why, and maybe there's upside based off of that. So those are just some hard and fast rules or things you can look at.
So for a company like Safaricom, what do you compare it to?
So other telecommunication companies globally. So not only in Kenya, but Africa.
Oh.
Yeah.
Nice. If you had to give one piece of advice to a new investor in the Kenyan stock market, what would that piece of advice be?
Well, I think take your time. You know, it's not a rush. I think mistakes I've made is because I'm thinking, I need to do this here and now and achieve this here and now. Yet, you know, there's time. Just take your time. Opportunities will always be there. Yeah, and don't, because if you do things rushed, that's how you try to make money quickly, you lose it quickly, in a sense.
Yeah.
Yeah. So oftentimes, it's just learning, growing, understanding, and then eventually applying. And yeah, you grow in that way. You know, it's like building a muscle. So you go to the gym consistently, the muscle build-up comes over time, not just on day one. Yeah.
Nice. So you have time.
Yeah, you have time. Take your time.
Take your time.
Yeah.
Nice. So thank you so much, David,
Yeah.
for being here with us. If any of our viewers would like to get in touch with you, where can they find you?
So you can just, I'm literally only on LinkedIn, just Davis Gadinji. Just search that on LinkedIn. Yeah, you can find me there. I try comment on stocks whenever I can. Yeah, that's where I am. Yeah, but thanks for having me.
Awesome. Thank you so much. So you've had it. He's on LinkedIn. See him there.
Okay, bye.
Thank you.